Bismillahirrahmanirrahim. In the previous class, we discussed about the statement of changes in equity. Then we discussed a bit about cash flow statement. We discussed that cash flow statement presents the movement in cash and bank balances over a period. Basically, bank balance, it is also cash. One is cash in hand and the other is cash at bank. So overall, it is what? It is cash. So the statement of cash flow, it presents the movement in cash. How much cash is going out of the business and how much cash is coming into the business. So it is concerned about the cash inflow and cash outflow. The movement in cash flows is classified into the following segments. One was operating activities, the other was investing activities, and the third one was financing activities. We discussed about operating activities, that it is basically the main operations of the business. Then we discussed about investing activities. Investing activities means purchase of assets and sales of assets. By purchasing, cash is going out of the business, and by selling assets, cash is coming into the business. And the third one is financing activities, when you are raising funds through debt financing or equity financing, and the repayment of that debt, that is basically repayment of debt and equity, that is basically financing activities. Today we are going in detail of this cash flow statement. Basis of preparation. Statement of cash flows presents the movement in cash and cash equivalents over the period. Now, cash and cash equivalents generally consist of the following. What is cash and what are cash equivalents? These things are included in that. Cash in hand, I told you about this. This is a part of cash. Cash at bank, this is a part of cash. The third thing is short-term investments. Now, what are short-term investments? That are highly liquid and involve very low risk of change in value. These are highly liquid securities. Liquid means any time you can convert it to cash. You can sell it, you can convert it to cash. And the next thing is very low risk of change in value. And there is a very low risk that their value will change. Suppose we purchased it for $10. So there is a very low risk that the value will come down. So we call these securities marketable securities. Therefore, usually exclude investment in equity instruments. Shares are not included in this because equity investments are highly risky. So these are basically short-term investments. Basically, cash equivalents are those securities whose remaining maturity is less than 3 months. So short-term investment, I told you these are those securities which are highly liquid, the first thing, and the second thing is low risk. There is very low risk of change in value. You can take treasury bills and commercial papers in this segment. Then the fourth item is bank overdraft. When you have a bank account, in that bank account there is a facility. That facility is if you want to withdraw more cash than your deposited amount, we call it bank overdraft. Suppose in your bank account there is $1 million. Okay, 1 million, leave 1 million, $100,000. But bank gives you a facility. What is that facility? If you need up to $1,10,000, you can withdraw 1,10,000. So 1 lakh is your own money, but $10,000, this is additional amount. This 10,000 additional amount in excess of your deposited money, this is called overdraft. But keep in mind, this facility is not available to each and every person. See here. In cases where they comprise an integral element of the organization's treasury management. Some companies, they are using bank overdraft as an integral element of their cash management, where bank account is allowed to float between a positive and negative balance. I told you that your deposited amount is 1 lakh. So it will go into the negative when you will withdraw 1,10,000. Bank will give you a limit. Within that limit, you can go to that negative balance. Means now, previously you deposited money in the bank. So your balance was a plus balance. But then when you withdrawn 10,000 additional, now you are in negative balance. We call this negative balance overdraft. As opposed to a bank overdraft, facility specifically negotiated for financing shortfall in funds. Sometime if there is shortage of funds, then you can use this facility. In which case, the related cash flows will be classified under financing activities. If you're using this bank overdraft facility, so cash is coming into the business. So in that case, that cash flow will be classified under financing activity. That is a financing activity of the cash flow. All cash flows are classified under operating, investing, and financing activities as discussed below. So here we were talking about cash and cash equivalents. So these are basically parts of cash. Cash in hand, cash at bank, short-term investments. These are liquid, so that's why we considered it equivalent to cash. And then bank overdraft. Which things are coming in operating activities? Cash flow from operating activities presents the movements in cash during an accounting period from the primary revenue generating activities of the entity. Now, I told you that it is concerned about the main revenue generation activity. Like suppose, here is an example. Operating activities of a hotel will include cash inflows and outflows from the hotel business. receipts from sales revenue, salaries paid during the year, etc. Now, if it is a hoteling business, so in hoteling business, you are preparing foods and providing some other facilities, so you are generating cash from that. So that is the main revenue generation activity. Then you are paying salaries of the employees, you are paying rent, you are paying the electricity bills, you are paying different other type of expenses. So these are basically our main activities. Cash is coming for your sales revenue and you are doing some expenses. So cash is going out because of that expenses. But keep in mind, interest income on a bank deposit shall not be classified as such. Now, you deposited money in a bank account and on that money, bank is paying you interest. Keep in mind, it will not be included in your sales revenue. That is other activities. Shall not be classified as such. The hotel's interest income shall be presented in investing activity. This hotel interest income, it will be an investing activity because this is an investment. You deposited money in fixed deposit so that you can generate money on that. So this is not operating activity, keep in mind. In hotel, your main activity is sales of food items. The expenses are rent, salaries, electricity, telephone, and all other things. But if you deposited some money in a bank account and on that money bank is paying you interest, so that is not your main operating activity. Your operations are these. This deposited money in the bank, you have excess cash, so you deposit it in the bank, so bank will pay you interest. So this will be considered investing activity. Profit before tax as presented in the income statement could be used as a starting point to calculate the cash flow from operating activities. Profit before tax, it will be our starting point. When we will make it, then I will tell you about this. Following adjustments are required to be made to the profit before tax to arrive at the cash flow from operations. Now we will make these adjustments in this profit before taxes. Elimination of non-cash expenses. Now there are some expenses which are not cash expenses, which are non-cash expenses. But we include it in our expenses, like depreciation. You know about depreciation. Depreciation is not paid in the form of cash. This is an expense, but it is not in the form of cash. So we will deduct it. This is profit before tax. Suppose it is 1 lakh. So from this, we will deduct depreciation because depreciation is non-cash expense. Suppose depreciation is 2000. So what will be left? 98,000. Keep in mind, this depreciation, this is not in the form of cash, so it will not affect the cash flow. Cash is not going, but it is an expense. Depreciation of building, it is an expense, but it is not in the form of cash, so it will not affect our cash flow. But in profit before taxes, this depreciation expense, okay, sales, cost of goods sold, so we are getting what? Gross profit. Then in gross profit, then we are deducting selling, general and admin expenses. Now this depreciation is coming in this selling, general and admin expenses. So we are getting profit, EBIT. This is our operating income. Then from this we are deducting interest expense. Then we are getting EBT, earning before taxes. So this will be our starting point. Now keep in mind, in selling, general and admin expenses, there is an expense by the name of depreciation. But that depreciation, we did not pay this depreciation in the form of cash. It is an expense, but we didn't pay it. So it will not affect the cash. So that's why from this EBT we will deduct this depreciation. Amortization, another type of expense. Amortization, it is for basically land, for buildings and these things. There is depreciation. Amortization is basically, suppose if there is a land, that land is full of coal and you're extracting that coal from that land, so the value of that land, it will come down. Suppose the value of that land, it was 1 million before extraction, but when you are extracting the coal, so its value will come down. It will come down to 1 million, so it will come down to 9 lakh, then 8 lakh, then 7 lakh, so it will come down. This is called amortization. So we will also deduct this amortization because the value of land comes down, but it is not in the form of cash. This reduction in value, this is not in the form of cash. Impairment losses. Impairment losses, these are basically damage, injury. Suppose there is some lawsuit and we don't know about that lawsuit, that whether we will win it or we will lose it. So that, and another thing is that suppose there is injury to some employee, so that is coming in that. Then bad debts written off. Bad debts, we sold goods on credit, but those creditors, they didn't pay that money. We include it in cash. It is coming in our cash. But since we write off that, so we will deduct it. There is a customer. We sold goods whose value was $5,000. But that customer is disappeared. So what will we do now? This 5,000, we include it in our sales. See, it is here in sales, but he is disappeared. So when he is disappeared, so this EBT, it will come down. Our profit will come down. Suppose our EBT is 100,000. Now when this customer will not pay this money, so this 5,000 we will deduct it because it will affect our cash flow. So now how much will be left? 95,000. So these expenses, these non-cash expenses, because we are talking about the cash flow statement, so non-cash expenses will be deducted. In these non-cash flow expenses, one is depreciation, one is amortization, one is impairment loss, and one is bad debt expenses. So we will deduct all these expenses because all of these are non-cash expenses. Basically, this thing, this impairment, it is, I told you, just like it is injury. Suppose you purchased some shares or bonds. The value of these shares and bonds, it was 100,000. But after some time, suppose the value can go up, it can come down. Suppose it comes down to 90,000. So there is a 10,000 loss. But this loss is not in the form of cash. Why? Still these shares are with the company. We didn't convert it to cash. When you will convert it to cash, then you will specify this. But since it is in the hands of company, 90,000, maybe after some time its value will again go up. But it is non-cash. It is, this loss is not in the form of cash. So we call it impairment loss, that there is a reduction in the value of an asset. So we call it impairment loss. So since it is not in the form of cash, so we will not deduct it. So sorry, we will deduct it here because it is not affecting the cash flow. I told you, suppose you have bonds whose value is 100,000. After 3 months, the value of these bonds, it comes down to 90,000. But still you are holding these bonds. When you are holding these bonds, so it is not affecting the cash flow. You didn't sell it. So there is a loss, but this loss is not in the form of cash. That's why we are deducting it here. Removal of expenses to be classified elsewhere in the cash flow statement. Those expenses, like interest expenses, should be classified under financing activities. Now keep in mind what I told you here. Selling, general and admin expenses. Then here we discussed EBIT. Then we deduct interest expense. But this interest expense, this is a financing activity. When you're taking loan, you're paying interest on that. So that is what? That is a financing activity. So that's why we will deduct this interest expense from this EBT, because this will be included, this interest expense, it will be included in financing activity. And we are calculating here what? Operating activities. So since interest expense is A financing activity, so from operating activities we will deduct it. Suppose there is interest expense of 5,000. So we will get 90,000, because we are calculating operating activities. So financing activity, we are deducting this financing activity to get the actual amount of operating activity. Elimination of non-cash income. Just like here, there was impairment loss. Similarly, there can be profit. Elimination of non-cash income, gains on revaluation of investment. Just like I told you, the value of this asset, it comes down, so it is non-cash loss. It also can go up. The value of these bonds, it can go up to 110,000. So there is a profit of 10,000. But since we didn't convert it to cash, it will be profit when you will sell these bonds. So that profit will be in the form of cash. But since we didn't convert it to cash, so we didn't receive the cash. So you will not include it in cash flow. I told you, keep in mind one thing. In cash flow, only cash inflow and outflow will be considered. But here, there is a profit, there is an income, but that income is not realized yet. We didn't sell the bonds. So when you didn't sell the bonds, so that cash is not realized, that profit is not in the form of cash. So non-cash income, we are not concerned about that. In cash flow, we are concerned about the cash which is coming and cash which is going. Removal of income to be presented elsewhere in the cash flow statement. There are some cash flows that will be presented elsewhere in the cash flow statement, like dividend income and interest income should be classified under investing activities, unless in case of, for example, an investment bank. We are not talking about investment bank. So the dividend that the company is receiving on their investment, that will be an investing activity. And if you deposited money in a bank, interest income, that will also be an investing activity. Suppose the company deposit $100,000 in bank, in fixed deposit. Bank is paying 9% interest on that. So after 1 year, there will be a $9,000 profit, and that profit will be deposited into your bank account. Your investment, it will become 1,09,000 after 1 year. But since this $9,000, it is an investing activity, you invested money in the bank, so you will include it in investing activity. From operating activity, we will deduct it, because this is not operating activity, this 9,000. And if you purchased shares of a company, and on that shares you receive dividend, suppose you receive dividend of 5,000, that is also an investing activity. So you will include it in investing activity, and if there is operating activity, you will deduct it from that. Suppose operating profit, it is 100,000. So from that, we will deduct this 5,000 and this 9,000. Interest and dividend, it will be deducted from that. Working capital changes. An increase in trade receivable must be deducted to arrive at sales revenue. Keep in mind, trade receivables, account receivable and note receivables, these will be deducted. Why? This is non-cash money. Suppose there are two types of sales. One is cash sales and the other is credit sales. Now cash sales, it is in the form of cash, so it will be part of the cash flow statement. But credit sales, receivables, it is not in the form of cash. So what will we do? We will deduct it. See here, sales, cost of goods sold. So here I include all sales, both cash sales and credit sales. When I was generating EBT. So from EBT, what will we do? Cash sales will be included, but credit sales, if there is credit sale, suppose there is credit sale of 30,000. So we didn't receive this money. So when you didn't receive this money, suppose EBT is 100,000. So we will deduct this credit sales, 30,000. Actually, we received how much? We received 70,000. Since we are concerned about what? Only the cash. So credit sales, it will be deducted from EBT. Okay, so these are basically the amounts that we will deduct from the EBT. I told you that EBT is our starting point. So we will deduct non-cash expenses like depreciation, amortization, impairment, and bad debts, because these are non-cash expenses. And in cash flow statement, we are concerned about only cash expenses, that expenses that you are paying, in which cash is going out. So these are non-cash expenses, so we will deduct it. Removal of expenses to be classified elsewhere in cash flow. Interest expense is a financing activity. So from operating activities, we will deduct this interest expense, because we are calculating what? Here, see, we are concerned about what? Operating activities. So in operating activities, since interest expense is included in EBT, when we are writing EBT, so there is interest expense here, interest expense about this in income statement. Just a minute, I will show you this whole. Now check. This is income statement. Now see, sales, cost of goods sold, gross profit, selling general and admin expenses, EBIT, and see, this is interest expense. So we deduct interest expense here. Since this interest expense, this is an investing activity, so from this EBT operating activity, we will deduct it because it is affecting our cash. Then elimination of non-cash income, just like I told you, revaluation of investments, removal of income to be presented elsewhere, just like dividend income and interest income. Since this is investing activity, so it will go into the investing activity, we will deduct. And credit sales, we will deduct credit sales because credit sales is not in the form of cash. When you will receive cash, then it will be included. But if you didn't receive cash, that will be deducted from your EBIT. Inshallah, in the next class, then we will talk about other things, the investing activities and the financing activities.